Do I have a PFIC and what are the tax rules? Imagine investing in foreign funds and suddenly facing a surprise tax bill that's much higher than expected. That's what can happen if your investment is classified as a passive foreign investment company. Let's break down what that means and how to handle it. A passive foreign investment company is a foreign corporation where either 75% or more of its gross income is passive income, like dividends, interest, rents, royalties, or capital gains. Or at least 50% of its assets are producing passive income. This classification is important because the United States has strict tax rules for these companies. If you own shares in a PFIC, you might face higher taxes and complex reporting requirements. Common PFICs include foreign mutual funds, foreign exchange-traded funds, foreign real estate investment trusts, and some foreign pension or insurance funds. On the other hand, investments in active foreign companies, like large corporations such as Shell or HSBC, usually are not PFICs. U.S. taxpayers, including Asian American investors, need to be aware of PFIC rules because foreign mutual funds and investment vehicles often qualify as PFICs. If you do not report your PFIC holdings correctly, you could face unexpected taxes and penalties. To find out if you have a PFIC, check if the foreign corporation meets the income or asset test. If 75% or more of its income is passive, or if 50% or more of its assets are passive, it is a PFIC. When you own PFIC shares, you must file IRS Form 8621 every year. This form reports your ownership and income from the PFIC. There are three main ways to handle PFIC income for tax purposes. The first is the excess distribution method, which applies high taxes and interest charges on distributions and gains. The second is the mark-to-market election, where you pay taxes annually on the increase in value of your shares, treating gains as ordinary income. The third is the qualified electing fund, or QEF, election. This allows you to treat the PFIC's income as if it were passed through to you each year, often resulting in lower taxes and deferral of gains until you sell. Some small investments, usually under $25,000, or certain foreign pension plans, may be exempt from PFIC rules. To manage PFIC issues effectively, review your investment statements for PFIC status or annual statements. Consulting with a tax professional familiar with international tax rules can help you choose the best election method. Keeping detailed records of your foreign investments and their values is also very helpful when completing IRS Form 8621. For many Asian American taxpayers, especially those with international ties or investments abroad, understanding PFIC rules is key to avoiding surprises at tax time. If you hold foreign mutual funds or similar investments that generate mostly passive income, you likely have a PFIC. Being aware of these rules and reporting requirements can save you from costly penalties and help you stay compliant with U.S. tax laws.